Picture this. You walk into your bank to withdraw your money. The teller smiles at you. Your account balance shows up perfectly on the screen. Everything looks completely normal. But when you ask for your cash, they tell you to come back tomorrow. You return the next day, and they say maybe next week. The numbers are still there, but the money isn't. Your wealth exists on paper, but you can't actually touch it. Sound like a nightmare? Well, this exact scenario is unfolding right now in a $1 trillion global market, and almost nobody is talking about it. Stay with me, because what I'm about to reveal will completely change how you think about every investment you own. Hey, I'm back with another Money Aftermath deep dive, and today we're exploring something that should genuinely concern anyone who has money in any market: stocks, crypto, commodities, even the cash sitting in your bank account. Before we go any further, do me a quick favor. Smash that subscribe button and hit the bell icon, because I'm bringing you the kind of financial education that could literally protect your wealth. The information I'm sharing today isn't something you'll hear on mainstream financial news, and it's definitely not what they teach in economics classes. And if you find value in what I'm explaining, drop a comment below and let me know. I read every single one, and your engagement helps more people discover this content. Trust me, you're going to want to stay until the end of this video, because the implications of what we're discussing reach far beyond just one commodity market. Now, let me ask you something. What do you think is more dangerous in a market? Massive price swings or complete silence? Most people would say volatility, right? They fear those dramatic drops, those red candles that make your stomach turn. But here's what experienced traders know that most people don't. Volatility means the market is alive. It's functioning. People are buying, selling, disagreeing about value, and that disagreement creates movement. You can protect yourself in a volatile market. You can use stop losses. You can hedge your positions. The game is still being played. But when a market goes silent, when liquidity evaporates and trading freezes up, that's when things get truly terrifying. Because the price you see on your screen becomes nothing more than a number, disconnected from any real transaction. It's like watching a clock that stopped hours ago, but you don't realize it yet. Let me break down what's actually happening right now in the silver market, and why it matters to you even if you've never touched silver in your life. Silver recently finished 2024 at around $29 per ounce, climbing over 20% for the year. It reached a 12-year high above $34 in October. On paper, everything looks relatively normal. Prices are quoted every day. Charts show movement. Financial news mentions it occasionally. But underneath the surface, something strange is developing. We're seeing what market insiders call a structural liquidity problem, and it's the kind of issue that doesn't announce itself with sirens and flashing lights. It creeps in slowly until one day, the entire system seizes up and everyone asks how nobody saw it coming. Here's what you need to understand about how markets actually function in the real world, not the sanitized version they teach you in school. In textbook economics, markets work through direct interaction between buyers and sellers. Someone wants to sell their house, someone else wants to buy it, they negotiate a price, done deal. Clean and simple. But modern financial markets don't work that way at all. Instead, they operate on something called a market maker system. These are usually large banks or specialized trading firms that constantly quote both a buy price and a sell price. Think of them as the middlemen standing in the center of every transaction. They're always ready to buy from sellers and sell to buyers, and they make their profit from the spread, that tiny gap between what they'll pay and what they'll charge. These market makers are the invisible infrastructure of finance. They're the pipes that water flows through. Without them, trading doesn't happen. Your stock trades, your commodity purchases, your currency exchanges, they all flow through these market makers. And here's the critical part that most people never think about. These market makers are on a public service. They're not obligated to always be there. They're private, profit-seeking entities managing their own risk. And when conditions get too risky, too uncertain, too volatile, they have every right to step back. They can widen their spreads to discourage trading, or in extreme situations, they can simply stop quoting prices altogether. When that happens, you get what we call a liquidity crisis. The market doesn't crash in the traditional sense, it just freezes. Now, before I go deeper into this, I want to make something crystal clear. Everything I'm sharing today is purely educational. I'm not a financial advisor. I'm not telling you to buy or sell anything. I'm an educator analyzing market mechanics so you can make more informed decisions. Always do your own research and consult with licensed professionals before making any investment choices. My goal here is to help you understand how these systems actually work, not to give you specific trading advice. So what does a real liquidity crisis actually look like? And why is it more dangerous than a price crash? Let me paint you a picture. Most people panic when they see big price drops. They watch their portfolio values tumble, and it feels like losing money. But experienced market participants know that volatility, even downward volatility, is actually healthy. It means the market is working. Buyers and sellers are actively disagreeing about value. And that disagreement shows up as price movement. You can make decisions in a volatile market. You can cut losses. You can buy the dip if you believe in the asset. The machinery is still running. But when liquidity disappears, something far stranger and more insidious happens. Prices might barely move at all because actual trading has essentially stopped. The number on your screen becomes increasingly fictional. It's based on the last trade that happened, which might have been hours or even days ago in extreme cases. It's like looking at a thermometer that says 72 degrees while your house is actively on fire. The instrument isn't technically broken, but it's no longer measuring anything meaningful. And if you try to actually execute a trade, you discover that the price you're seeing and the price you can actually get are two completely different things. Let me walk you through how liquidity disappears in stages, because understanding this progression is crucial. First, you'll notice the bid-ask spread starting to widen. Under normal conditions, the difference between what someone will pay to buy and what someone will charge to sell might be pennies or even fractions of a penny. But as market makers perceive increased risk, that spread starts expanding. It goes from pennies to dollars, then to $5, $10 or more. That widening spread is market makers telling you that they need more profit cushion to justify staying in the game. They're not being greedy. They're protecting themselves against the risk of getting caught holding the wrong position when things go haywire. And the second stage is when you start seeing fewer price updates. In a healthy, liquid market, prices tick constantly, sometimes multiple times per second. But as market makers pull back, those updates slow down. Instead of every second, you see updates every minute, then every 5 minutes. That's because fewer market makers are actively quoting prices, and those who remain are being more cautious about how often they update their quotes. They're constantly reassessing risk. The third stage is the critical one, and this is where things get genuinely concerning. You start seeing situations where the bid and ask prices are so absurdly far apart that no rational person would accept either one. Imagine silver showing a bid price of $70, meaning that's the highest price anyone is willing to pay to buy, and an ask price of $95, meaning that's the lowest price anyone is willing to sell. Nobody's buying at $95 when they could theoretically buy at $70. And nobody's selling at $70 when they could theoretically sell at $95. So nothing actually trades. The market hasn't technically closed. It's still open. Prices are still being quoted, but it's functionally frozen. And here's what makes this situation genuinely dangerous. All the financial instruments built on top of that underlying market, the futures contracts, the exchange-traded funds, the options, they all keep trading based on the last available price. But that price is now essentially fiction. It's a ghost from the past. The real price, the price at which actual physical transactions could occur, might be wildly different. But nobody knows what it is because nobody's actually transacting in size. You're flying blind. If you're still watching, thank you for sticking with me, because we're about to get into the really fascinating part. Make sure you hit that like button if you're finding this valuable, and definitely drop a comment below telling me what markets you're concerned about. Your engagement helps this channel grow and helps more people access this kind of critical financial education. And if you haven't subscribed yet, what are you waiting for? This is the kind of in-depth analysis you won't find anywhere else. Now, let's talk about one of the most important concepts in modern finance that almost nobody outside of professional trading circles truly understands: the distinction between paper markets and physical markets. For most commodities, there are essentially two parallel universes of trading happening simultaneously. There's the paper market, where contracts representing the commodity trade electronically on exchanges and through over-the-counter deals. And then there's the physical market, where actual material, real bars of silver, barrels of oil, bushels of wheat, physically changes hands. Under normal circumstances, these two markets stay synchronized through a mechanism called arbitrage. If the paper price gets too high compared to the physical price, traders will buy physical material and simultaneously sell paper contracts, bringing the prices back into alignment. If paper gets too cheap relative to physical, they'll do the reverse. This arbitrage keeps the two markets dancing together. But when liquidity dries up in the physical market, this arbitrage mechanism breaks down. The paper market can keep trading, displaying prices, creating the illusion that everything is normal, while the physical market is completely frozen or experiencing extreme stress. And if you own paper contracts, whether they're futures, exchange-traded funds, or unallocated accounts, you're suddenly exposed to a terrifying question. Can you actually convert this paper into physical material if you need to? Or are you holding a claim on something that doesn't exist in accessible form? This isn't some conspiracy theory. This is basic market structure, and it becomes critically important during times of stress. Let's ground this in what's actually happening right now with silver. Global silver demand in 2024 hit 1.21 billion ounces, the second highest year on record. Industrial demand is surging primarily because of solar panel manufacturing, which now consumes roughly 20% of total annual silver production. Think about that for a second. 1/5 of all the silver mined globally every year is going into solar panels alone. This isn't speculative demand from investors hoping the price goes up. This is actual industrial consumption. That silver is being turned into products that can't give it back. It's not sitting in a vault waiting to be resold. It's locked into solar panels on rooftops across the world. Meanwhile, on the supply side, we're facing what analysts call a structural deficit. Mining operations are dealing with declining ore grades, meaning they have to dig up more rock to get the same amount of silver. Production costs are rising. And here's a critical point that most people don't realize. 70% of silver comes as a byproduct of mining other metals like zinc, lead, and copper. You can't just decide to mine more silver. You'd have to expand entire base metal mining operations, which requires years of investment, permitting, development, and planning. Supply cannot respond quickly to price changes, so we have record industrial demand that cannot be postponed, supply that cannot rapidly increase, and exchange inventories that have been falling. Yet the price, while it's risen, hasn't exploded in the way simple supply and demand economics would suggest. Why? This is where understanding market structure becomes crucial. The price you see quoted for silver is determined primarily by futures trading on exchanges like COMEX in New York and over-the-counter markets in London. These are paper contracts, financial instruments that represent claims on silver, but are mostly settled in cash, not actual metal delivery. Under normal market conditions, the paper price and physical price stay aligned through that arbitrage I mentioned earlier. But when the physical market experiences stress, when vaults become reluctant to release metal, when refiners can't produce fast,